notice the bank doesn't care if you lost your job, whether you got sick or your income has just dropped? They still want that mortgage paid on the first, no delay, no excuses. But here's the catch. You've been doing everything right. You've been grinding at work, paying the bills, been building equity, and now you need that money back. You need your equity in your pocket. But you think your house and your bank has your back? They don't. You could be sitting on $200,000 of equity and still not be able to use it without their permission. You see, you don't control it. The bank does. Now, that's not wealth. That's a trap. Let me break it down, starting in 3, 2, 1. Let's go.
Hey, 7-figure squad. What we go? Run it up, run it up.
What's cracking, everybody? Money Smart Guy, Matt Sapaula here, hailing to you from Dallas, Texas. And if this is your first time watching, welcome to the Keep the Keys Financial Wake Up Series. Now, here's a quick recap, the last previous episodes. Episode number 1, we talked about how people lose their homes even when they do everything right. Episode 2, we talked about taxes and inflation, how they silently erode your wealth, especially with inside 401k and IRA plans. And then episode 3, we talked about why equity without access is just paper wealth. Last, we talked about episode 4 and how to think like a billionaire mindset, even if you aren't one. A millionaire mindset, even if you aren't one. And today, episode 5, we're talking about why so many homeowners are house rich and freedom poor. But before we jump in, drop the word clarity in the comment section below if you want that actual scorecard we've used with different families and how they can score themselves in this process. So therefore, it's more of a systematic type of outlook, not just in your feels. Or drop the word equity if you're tired of being asset rich but still stuck financially. Now, the problem with traditional equity thinking is this. Most homeowners are taught one script. They were taught what? You know the script. Buy a house, pay it down, build equity, retire. And on paper, that sounds smart. That is, until life happens. Because equity in a trapped asset is just that. It's trapped. You can't swipe it. You can't Venmo it. You can't eat it. You can't access it in an emergency without begging a bank. But for example, let's say you built $200,000 of equity in your property. Now, in order for you to touch it, you got to do one of 3 things. You got to refinance the house, and you hope your rates are still in your favor. Number 2, you got to sell your home. And what do? Possibly lose your space. You pay fees, realtor fees, commissions, and reset back that equity clock. Or number 3, you try a HELOC, a home equity line of credit with all the strings attached. Bottom line, which is what? Bank approval, debt to income ratio, credit score checks, underwriting, sadly, delays. Now, what happens if the stock market crashes or the real estate market crashes? Poof, that equity is gone. Just like we experienced in 2007 to 2010, and just like we experienced in 2020 during the pandemic. Let me give a real client case study. Some of you guys are wrestling fans. Well, one of my wrestling fans is the almighty Bobby Lashley. I ran into him at the gym, built a friendship, and became a client. And he moves differently than all the wrestlers. I'll put a link here to the interview we did. What a lot of people don't know, he's also a commercial real estate investor. Now, I won't share you all his personal details. That's client confidentiality. But what I can say this is what we publicly disclosed on the podcast previously. He became a client because he saw what most people miss. Instead of tying up all of his cash in properties or low yield savings, we helped him establish a life insurance retirement plan using an index universal life policy. We structured so therefore he can stack a lot of cash inside a policy. It was designed for high cash accumulation. So he's building equity, not in the property, but he's building equity within inside the policy. And he had full access when opportunity came knocking. And when the deal popped up, he gives me a call. We fill out a couple forms. He didn't have to sell his house. He didn't have to refinance through a banker. He didn't have to wait on approval or underwriting. He moved fast with control, with peace of mind, money direct deposit back into his checking account. The policy still carries a living benefit in case Bobby were to ever experience a heart attack, stroke, or cancer, and he survived, Lord forbid, but he's got those financial situations in order, and he built protection, and then he became the bank. In a previous episode, I brought up Jay-Z and Beyoncé because I think it's a relevant case study for us to review. Because some of you guys say, cool for Bobby. What about the ultra rich? What do they do about it? Isn't all their houses paid off? Let me show you how billionaires play. Jay-Z and Beyoncé took out a $57.75 million mortgage on their $88 million Bel Air mansion. Now, you think they really needed the money? No. You think they're struggling to pay the bills? No. But if you add up the net worth combined, they're about $3.5 billion with a B. So why do they do it? They want 3 things I stated before. Liquidity, they wanted leverage, and they want legacy. Now they control over $110 million in capital just through that one property without selling a square foot of that real estate. See, that's how you play the wealth game. You use equity to earn you a rate of return. It just doesn't sit there dormant. They're not sitting on the cash. Now, Jay-Z and Beyoncé and anybody who follows the strategy, they can potentially buy more real estate, buy more businesses. They can fund their family trust. Because when you control your cash, you control the chessboard. Now, you don't need $1 billion to think like a billionaire. What you do need is clarity. See, most multicultural middle-class families aren't broke. They make money. Their money is just trapped and they're putting their money in the wrong places. Now, they've got equity, they got retirement savings, they got decent income, but they don't have liquidity. They don't have a strategy. They don't have any control, and they're winging it, shooting from the hip. And that's why I created the CLARITY Scorecard. And the scorecard is a checklist, 7 questions to help families like yours figure out where your money is locked up and how to unlock it without starting financially over. Because when you're clear about your financial decisions, you make better decisions. You stop waiting for permission and you move quickly. Now, I know you don't need another motivational quote. You don't even need another podcast. But you need a real conversation that changes your life. You're one question away. You're one strategy away from a financial breakthrough. But most people, they ask the wrong people and they wonder why they get stuck. Now, if you're serious, you can pick my brain. You can pick my heart. You can pick the battle scars I've earned through building my faith, my finance, my family, my future. But it's going to cost you one thing. It's going to cost you commitment. No free handouts, no magic tricks, just straight wisdom when you need it the most. How do you connect with me? Go to Connect. Let's build your breakthrough long before somebody else tries to. As I wrap up, if equity cannot be accessed, it's not wealth. It's a mirage. The wealthy borrow against assets, and what they do with it, they multiply it. The broke, they sit on assets, they sit in fear, and they brag about what they own. And sadly, life passes them by. Opportunities pass them by and leave a lot of bread on the table. So here's my challenge. Before you brag about ownership, which by the way, congratulations, salute to you. But ask yourself this, can you actually use the value you've built? Or are you house rich and cash and freedom poor? And I'm just curious, as I wrap up, what is your biggest takeaway from this episode? Please drop it in the comments below. I want to hear from you. And if you haven't subscribed yet, make sure you hit that subscribe button. Let's grow together. Next week, episode 6, we're going deep into one of the biggest retirement lies in America. Why Social Security may not save you. Why the 401k isn't as safe as they told you. You know why it's time to stop outsourcing your future. You don't want to miss it. Appreciate you guys tuning in. Until we meet again, continue to live smart, continue to love smart, and be money smart today.